Hi everybody, this is Gary Dean and this is our nightly video report for Tuesday, February 2nd, 2016. So markets pretty much got walloped today. And we got some clues from it yesterday, and I closed my short position with SDS, and my primary reason was that we're getting some bullish divergences on the 15-minute chart. We hit a fib retracement with some support, and rolling the dice on not seeing massive rallies off of this or declines when we see negative divergences hasn't paid off. And yes, we definitely could head lower tomorrow, even throughout the rest of the week. It would not surprise me. But I just, Friday surprised me a lot. So I was caught on the wrong side, and I'm not overly bearish on this market. So made a tiny little bit on the trade. There was nothing big at all. But now we can look at the markets another way. If we would get a rally, then I'm going to look to possibly short it when I see things get overextended and some short-term sell signals. If we continue lower, then I may just sit aside and wait to buy. Wait for things to line up on that end of it. I'm hoping for a rally. I'd still like to take another stab on the short side. It may be a quick trade, but the way that we're seeing these markets move, quick trades could be anywhere from 60 to 70 points on the S&P. So one thing I want to just let you know is that this is really the first time I'm doing the two-time ETFs and off of the spiders. So what I really have to do is keep the same money amount in each trade. So if I buy SSO and I use X amount of dollars, when I buy SDS, I'm then going to use the same amount of dollars, and it's going to be obviously a lot more shares than what was with the SSO, because that's almost double the price as the SDS. So, little learning mistake on that as far as managing this, but it's not, not the end of the world on it. So anyway, let's get started. Hang on one second. Okay, I just wanted to see if this data had updated, but this is from 347 today. You can see yesterday I pointed out that we had the spiders. That was the bulls were selling the rally, and today they are buying the dip, and that's from the block trades and the total money flow. Again, doesn't mean that it's an automatic we head higher or lower when we see these, but it's something I want to pay attention to. So if we take a look at the regular charts, quick, I'm going to go to well, actually I can stay on the 60, because this is what gave us the clue to expected decline, and that was the bearish divergences on the 60-minute chart. Very overbought, and we ran right into the 50% retracement from this high to this low. So we had resistance, you had a moving average resistance, and we had bearish divergences. The path to least resistance was to the downside. So I had showed you that the first support was at right around that 1910, 1905 area, which was also this trend line support. That got taken out, so we may bounce a little bit. And really the main reason why I'm saying we could bounce is from this low to this high, we made it down to the 38% retracement, and if you notice, we have bullish divergences on the 15-minute chart. So if we get a bounce, really what I would be looking for is to possibly take a short position up at the 20, and then if they rally higher, maybe I would see how the bears defend this, because if they go above this, then there's a shot that we come all the way up to the 1940, and I don't really want to be short on that, and that's simply to close this gap right here. Now there's still a lot of gaps underneath that still have to be closed, and that's kind of one of the reasons why I believe that we're going to continue lower before higher. So if we get a bounce, keep an eye on this 1920 if you're self-trader. If they blow through that, then you want to keep an eye on that 1940, 1938 area. And if we get a bounce and then we come down and take these lows out, and that's at the 1895. There's probably going to be a real fast panic low down to the 1880, possibly even down to the 1875. So it'd say between the 1879, it could even go down to this level here, 1872. So this would kind of be your support, anywhere from this 1879, 1872. If they lose that, then we're looking at the 62% retracement, 1863. So even when we were up here, these are kind of my targets and why I'm not, overly bearish, but I still believe that there's more time, that there's still enough tank in the gas to take it lower, and that's pretty much because the 60-minute or momentum just passed through the midline, so there's plenty of gas to go on the downside if they want. But right now I'd love to see a bounce just because of the bullish divergences on the 15-minute chart. We landed at the 38% retracement, and then watch it get held down at the 1920. If they do that, I'll take a short trade, and again, my targets are going to be anywhere from the 1880 down to the 1863. From there, unless things start getting bear ugly, then you'd be eyeing down this 1840 and maybe a double bottom down to the 1811. But if we get down to these levels and I start seeing bullish divergences on the 60-minute chart, and this is very oversold, then I'm going to start looking to buy down here. So I'm neutral really short term, just because a bounce would make sense. I still think there's some more time and more room to go on the downside, but once that completes, I'm most likely going to be switching over to the bull side and expecting a lot of people to get caught on the wrong side of the tape again, because they're going to be going back to this ultra bearish view of the market real fast, especially if we see continued weakness. And we saw what happens when these squeezes take place. I mean, heck, I got caught in one on this, and it wasn't fun. We can see the same thing to the upside. So right now, if we head lower, so be it. You know what? So I'm going to be cash as we head lower. If we head higher, I'm going to keep an eye on a quick trade to the short side. And with that, enjoy the rest of your night, and I'll talk to you guys tomorrow.